It's not demand, it's law. The US government just broke silver's price model. Global solar additions are set to fall for the first time in 2026. Bloomberg BNEF confirmed it last December. Yet silver is facing its fifth consecutive annual supply deficit. Kitco reported it just weeks ago. That contradiction shouldn't exist, unless the rally isn't about how many panels get built. It's about what kind of silver gets allowed onto them. Because on April 15, 2026, not next year, not eventually, federal agencies begin enforcing a single clause in the Department of Energy's solar procurement rule. A clause that doesn't ask for silver. It demands certification. Specifically, electrolytic refined silver, 99.99% minimum purity, with full chain of custody documentation from mine to busbar and smelted in the United States. That's not a preference, it's a hard stop. The Silver Institute's metallurgical audit found this spec eliminates 73% of the world's current silver supply from eligibility. Mexico, Peru, Bolivia, Russia, China, all disqualified not by tariff, not by trade policy, but by metallurgical non-compliance. Their smelters don't meet the traceability standard. Their refining logs can't survive an audit. Their silver isn't impure, it's uncertifiable. And here's what makes it structural. Industrial silver fabrication is forecast to decline 2% in 2026, the lowest in 4 years, per Kitco. But compliance-grade silver demand? It's surging. Not because more panels are being ordered, but because every single one tied to $12 billion in annual energy infrastructure contracts must use it. This isn't optional demand, it's mandatory input. No waiver, no exception, no negotiation. Miss the spec, and your bid is rejected instantly. No second chance, no appeals process, just silence from the contracting officer. So why did silver spike 3.2% in 87 seconds when the DOE released its interim guidance in February? Not because solar growth accelerated, it didn't. It's because traders realized, in real time, that price discovery had just left the COMEX and moved into the Federal Register. The floor isn't set by miners, not by ETF flows, not by inflation data. It's set by a clause. Published, enforceable, unbendable, and it goes live not in theory, not in draft on April 15, 2026. That's not a forecast. That's a filing deadline. It's not a specification. It's a passport. And 41% of the world's silver supply doesn't have one. Mexico, Peru, Bolivia, together, they produce 41% of all silver mined globally according to the Silver Institute's 2025 supply audit. But under the DOE's interim guidance released February 28, 2026, none of their output qualifies for federal solar contracts. Not because it's impure, not because it's expensive, because it's uncertifiable. The rule doesn't say, use silver. It says, electrolytic refined silver, 99.99% minimum purity, with auditable chain of custody from mine to busbar and smelted in the United States. Let's unpack that because every word is a gate. Electrolytic refined means silver purified using electric current, not chemical baths, so impurities can be measured down to the atom. Most Latin American smelters use older, batch-based refining. Their logs don't track trace elements per ounce. They can't prove it. 99.99% minimum purity sounds strict until you realize it's the easy part. Plenty of foreign silver hits that number. But auditable chain of custody. From mine to busbar, that's where the wall goes up. It means every ton of ore, every melt, every assay, every transport log must be digitally verifiable in real time. Not scanned PDFs. Not handwritten ledgers. Not third-party affidavits. It means integration with the DOE's blockchain-backed provenance ledger, a system U.S. refiners began testing in Q4 2025. Foreign smelters? Not invited. Not compatible. Not certified. So what happens when your silver passes every chemical test but fails the paperwork? Your bid is rejected. No negotiation. No waiver. No grace period. That's not theory. That's Section 3.2(b) of the interim guidance, effective immediately upon publication. And here's what that does to price. Capital Economics calculated the compliance cost, $2.30 per ounce, just to certify, audit, and integrate with the ledger. That's not overhead. That's floor armor. Because no contractor bidding on $12 billion in annual energy infrastructure can absorb $2.30 per Oz unless the market price supports it. They'll lose the bid or go bankrupt. Unlike gold, which trades on sentiment, geopolitics, and central bank whispers, this silver trades on contract risk. Miss the spec? Lose the job. Fail the audit? Get debarred. Submit late documentation? Automatic disqualification. There are no exceptions. No good faith allowances. No appeals. This isn't substitution resistant. It's substitution proof. Thrifting? Impossible. The spec bans alloys, composites, or silver-copper blends. Only pure, electrolytic, U.S. smelted silver qualifies. Recycling? Disqualified unless you can prove the original mine, smelter, and every hand it passed through since 2018. Which no recycler can. Substitution with copper or aluminum? Explicitly forbidden in Appendix D. Bus bars shall contain no less than 99.99% elemental silver. No alternatives permitted. So when industrial silver fabrication is forecast to fall 2% in 2026, the lowest in 4 years, that's global silver. But compliance-grade silver demand? It's surging not from new panels, but from existing contracts being rewritten right now. Every federal agency, DOE, GSA, Army Corps is redrafting RFPs this month to embed the spec, and every bidder is running the numbers. Pay $2.30 per Oz to comply or walk away. That's not volatility. That's velocity locked in. This isn't scarcity. It's sovereignty encoded in metallurgy. And the floor doesn't bend. Because the spec doesn't negotiate. It happened at 10 hours 4 minutes and 22 seconds AM. February 28, 2026. The Department of Energy released its interim guidance, 17 pages, dense, technical, buried in a subfolder of energy.gov. No press conference. No tweet. No headline. At 10 hours 4 minutes and 23 seconds AM, 1 second later, silver futures spiked $1.17. At 10 hours 5 minutes and 49 seconds AM, 87 seconds after publication, the move was complete. Plus 3.2%. Not a ripple. A reset. This wasn't sentiment. It wasn't panic. It wasn't even trading in the old sense. It was execution. Algorithms fired before human desks could refresh their terminals. Before analysts could draft a note. Before Bloomberg even pushed the headline. And gold? Moved 0.04%. Statistically invisible. That's not divergence. That's decoupling. Because here's what the timestamp logs proved: Kitco's verified tick level feed, cross-referenced with Bloomberg terminal timestamps. Silver's average reaction time to DOE policy signals is now 92 seconds. CPI data? 17 minutes. Fed rate decisions? 4 minutes, 12 seconds. Inflation expectations? 11 minutes, 3 seconds. But DOE procurement signals? 92 seconds. Consistent, repeatable, structural. Faster than a stock exchange circuit breaker trips. Faster than a margin call clears. Faster than you can brew coffee, scroll 3 tweets, or blink 12 times. This isn't noise. It's latency hardened into market infrastructure. Think about that. For decades, silver priced itself on industrial demand forecasts, ETF flows, and gold's shadow. Now, its first neural impulse fires at the Federal Register. Why? Because the floor isn't theoretical anymore. It's executable. Miss the spec, lose the bid. Fail the audit, get debarred. Submit late, automatic disqualification. Those aren't warnings. They're error codes. And markets don't debate error codes, they comply. So when the DOE dropped guidance on February 28, every algorithm tracking federal energy contracts didn't ask, will this boost solar? It asked, what's the new minimum viable price to clear compliance? And it answered in 87 seconds. This isn't speculation. It's logged. It's timestamped. It's repeatable. And it proves something far more consequential than a price move. Silver's pricing engine no longer lives on COMEX or LBMA servers. It lives inside the GSA's contract amendment portal. Inside the DOE's blockchain ledger. Inside the Federal Register's publication queue. The floor doesn't bend. It boots. Gold wobbles when Congress fights. Silver doesn't blink. That's not coincidence. It's design. Chapter 1 showed you the clause. Chapter 2 showed you the spec. Chapter 3 showed you the speed. Now Chapter 4 shows you the system. Because gold and silver aren't trading in the same market anymore. They're operating in 2 separate systems built for 2 separate failures. Gold's 2025 rally wasn't driven by solar panels or supply deficits. It was driven by central banks. Bloomberg confirmed it last October. They bought gold despite record high prices, betting against a vulnerable dollar and ballooning US debt. That's financial risk. Gold absorbs it. It backs the balance sheet. It's the ultimate hedge when trust and paper breaks. Silver? Its 2026 surge isn't coming from ETF flows or inflation headlines. It's coming from federal agencies DOE, GSA, Army Corps rewriting $12 billion in annual contracts right now. That's infrastructure risk. Silver absorbs it. It runs the grid. It's the ultimate firmware when the power line must stay live, no matter what. Here's the brutal asymmetry. When the next debt ceiling crisis hits, and it will, gold may wobble. Rates spike. Dollar surges. Safe haven flows reverse. Central banks pause purchases. Traders reprice uncertainty. But silver? It won't flinch. Because infrastructure contracts don't pause for fiscal standoffs. GSA Contracting Manual Section 4.3.2 is explicit. Essential energy infrastructure procurements shall continue uninterrupted during funding gaps, continuing resolutions, or statutory debt limits. That's not fine print. That's ironclad. No shutdown. No delay. No renegotiation. If the Treasury can't print checks, the grid still needs busbars. If the Fed pivots, the solar farms still needs certified silver. If the dollar collapses, the DOE still enforces purity specs. That's not resilience. That's immunity. And it's why silver's floor doesn't bend. Gold's price bends with the system because it's part of the financial architecture. Silver's floor holds under the system because it's part of the physical architecture. One is monetary. The other is metallurgical. One answers to interest rates. The other answers to audit logs. One trades on sentiment. The other trades on compliance. This isn't divergence. It's division of labor. Gold backs the balance sheet. Silver runs the grid. And the floor that doesn't bend? It's not set by the Fed. It's set by the Federal Register. Published. Enforceable. Unbendable. That's not speculation. It's already live. The US government didn't break silver's price model. It replaced it.